Hey, what's up all of you beautiful subscribers? I'm Chapple, and today we're talking about the Holy Grail of investing. This comes from a billionaire hedge fund manager named Ray Dalio. He's worth like $20 billion or so. So he talked about this recently, about what his Holy Grail is, how he's been able to become so successful with investing. But it was a little bit too complicated for a lot of people out there. So I'm going to simplify this here and explain it to you in kind of my own words. I'll kind of put my own spin on it too. But here's his Holy Grail of investing. A little bit simplified. All right. So first of all, the 2 points are going to sound very simple here. So just stick with me. It's not this simple. All right. So his first one is he wants the highest return possible. Okay. So I know this is kind of a very obvious thing to say. You know, everyone wants the highest return possible on investment. You put in $5, you'd like $5 billion back. All right. But so we'll stick with that here. He wants the highest return possible, but here's the caveat, which is he also wants the lowest risk. Lowest, I did that wrong. Risk. So that's what he wants, the highest return with the lowest risk. But this gets a little bit complicated here, and this is where his strategy comes in. So I'll give you an example here. Let's say you want to invest, all right? So you find a stock, so you find one, and it has a high return. All right, you find one stock, it has a high return, and then you find another, and another, and another. So you find actually 4 stocks, high return on 4 stocks. You haven't looked at the risk yet. So how do you calculate risk of investing in a stock? Well, what he does is not only does he look at the company financials, and that's a whole separate video, and how well the company's doing, that's whole separate, but he looks at the industry. Give me an example here of everything he invests in. So let's go a little bit further here. So let's take case 1, so C1. So you decide, you find 4 companies, and they have a high correlation, all right, in terms of similarity. So we're going to say, I'm going to simplify this, called HC, high correlation. And this is because all of these companies with a high return and low risk they're all just so happen to be banking stocks. So 4 bank stocks. So Ray Dalio does not like this. This is a high correlation risk, meaning that pretty much what this means is that each one of these are in the same industry. Each one of them are tied together. I'm going to give you a different example here in a second here, but this is a big mistake. All right, if you invest a ton into the same industry, 4 different bank stocks, even if individually they have a high return and a low risk as a company, what he says is that because they're all in the same industry, that is a bad investment to make, especially when you have a small portfolio. So this is actually for him a high risk investment. 4 different bank stocks, even if they individually look good on paper, as a group, not so good. So now we're going to move on to the next one, which is MC, which is C2. Medium correlation. And so in this one, which is 2 banks, and then we got here, let's see what I wrote down here, which is 1 insurance company, 1 insurance, and then 1 credit card company, 1 credit card company. All right, so now this is a little bit less of a correlation. They're all still in the financial sector, right? Credit card company, maybe you go into Visa or Amex. And then you also have banks, so you could go into some American ones, there's tons of those out there. And then an insurance company, right? So they're all in the financial sector. They're all in different spaces within the financial sector, but they're all still within kind of the same industry. So this does cause a little bit of differentiation here. So it's less correlation and less risk as a whole as an investment, but still a little bit too risky for Ray Dalio. Move on here. We're going to go on to case 3. Case 3, which is the low correlation, which is Ones that, let's just go with banking. So we got a bank one. We got a energy company. And then we have here a real estate. And then we also have a car company. All right, now these are in separate industries, but they are all still connected. Some of them are still connected. All right, real estate is tied to banking because that's mortgages. That's how you get mortgages. Banking and real estate are kind of tied together. Energy is kind of tied to car companies, right? Because oil and cars are on oil for the most part still today. And banking and car companies, sometimes people get out loans that are not from their dealership, right? Sometimes they get it from the bank. But, for the most part, these are a little bit separate, right? They do interact with each other, but for the most part, they're relatively on their own. I mean, if the real estate industry, think about this. When the real estate industry crashed in 2007, a lot of energy companies, their stock price was affected, right? Because people had less money to invest. But their industry wasn't collapsing from beneath them. Real estate was. The energy sector was going down only because there was less investor money out there, right? The industry itself was not collapsing. The industry itself was still relatively healthy minus the stock prices. So we're going to get into correlation number 4. And this is the real holy grail when Ray Dalio starts investing, which is the 0C. All right, we should do the ZC, ZC, but I'm going to do 0C. All right, this is no correlation. So we're going to take an example here, which is, we're going to get a space company. We are going to get a fast food, space, fast food, e-commerce, and real estate. So these companies here at the bottom have no correlation, right? There might be some connections, like e-commerce, you could say Instacart, or Uber Eats or something with fast food. Okay, like real estate, maybe people like to get food delivered to their house, but space has nothing to do with any of these. For the most part, these are all on their own, right? These don't really have correlations with one another. So if you invest in real estate, space, fast food, e-commerce, each one of these stocks are individually have high returns and low risk, and there's no correlation between those stocks. So you have a dual thing happening here, is that all of these companies that I listed, we are assuming that they have a high return and a low risk. But if they're all in the same industry, they have a high risk. If they're all in separate industries, low risk. And even if they're in separate industries, again, they could still be tied together, like I mentioned before. Energy and cars, right? Banking and real estate, separate industries, but still technically tied together. So that's why the zero correlation here is what Ray Dalio aims for. So what he said is that his holy grail, coming down to the conclusion here, is that his holy grail of investing is that really, to make a big hedge fund or investment firm, investment bank, for a lot of you out there, you really only need 25 to 50 relatively uncorrelated or low correlation or zero correlation stocks. 25 to 50, and they also have to be healthy companies. They also have to individually be high returns, low risk, right? But they all have to fit into these two. That's his strategy. That's what and it makes sense. I don't completely agree with it. Get me wrong, I have my own strategy, especially, he's been running he has billions of dollars, and most of us do not. Most of us have thousands, tens of thousands of dollars, hundreds of thousands of dollars. All right, some of us have hundreds, some of us have only dozens of dollars, right? But again, this is a good strategy for diversification that a lot of people don't think about. So what I say, this is even kind of opened my eyes a little bit. Like I kind of assumed all this stuff, and like I get it too. I always say diversify and stuff too. But this gives you a kind of a good layout of what diversification actually means. You don't want all of your eggs in one industry. You also don't want all of your eggs in one industry that is is correlated to another industry that you're invested in. So you want at least a couple degrees of separation, I guess, from your other investments. So what do you guys think of this? What do you guys think of Ray Dalio? And first of all, did I interpret his words right? Maybe you can go and watch his video. He has a lot of, he has a graph and percentages and stuff, and I just really tried to simplify it down for most people to understand here. But again, I learned a lot. I learned from this video. I learned from Ray Dalio. I've read he's been involved in some other books too. I think he was in Tony Robbins' book actually. So I think he was in Unshakable. So go read that book. I think that was a good book where Tony Robbins talks about money a lot. I think it was him. But anyways, I have tons more videos on the stock market. So if you do like videos like this, I have tons more stock market videos on my channel. So subscribe to this channel and check out my other videos. So here's what I want you to do. I want you to hit the subscribe button. Preferably the like button too, because that really helps me out. And then you got to go click on some of my other videos. So I'll give you about 5 seconds to subscribe, and then I'll see you guys in like 4, 3, 2, 1 in another video. Bye-bye.